All right, we'll do it then.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Hannah, thank you for being here.
Thanks for having me.
Tell the people who you are, what you do, and what we're talking about today.
Yeah, so my name's Hannah Cannon. I'm an associate in the Trust and Estates Department at Woods Oviatt Gilman. Love working there. Love working in Trust and Estates. I'm licensed in New York and Florida, so I do a little bit of both. But yeah, happy to be here.
All right, love it. We had Dave Schaefer on maybe 2 months ago now. He's also from your firm, for those that don't know. And we did, I guess I would call it a general estate planning conversation, sort of the basis of why do you need a will and a trust and how all these documents work. So I thought with you today, we'd drill into maybe a more specific topic and question that we get a lot, and that is okay, I'm not going to live forever. I've accepted that. And I don't have an obvious beneficiary, meaning that maybe they don't have a child of their own, or they don't have somebody that they want to leave this money behind to. So then it becomes, what do I do with my money? And it's a broad topic. We can go a lot of different directions. But the most basic answer you can give of, I don't have a beneficiary, where do I leave my money? What are the options?
Yeah, absolutely. So I guess the biggest thing is it's totally up to you. So just thinking about, and sometimes that can be overwhelming. Okay, there's a lot of choices. There's either a lot of people I have in my life, or maybe just one or two that I'm close with, or maybe no one. So working through that there are a lot of different options. There's a lot that people can do in different ways. One of the biggest things I'd say in that instance would be charities. If there's organizations that the individual either volunteers with or works with, or just is hoping to benefit in their estate plan, that is always helpful. And there's a lot of different ways that can be done too. I think a lot of times our work is focused, if you hear estate plan, the first thing you think about is maybe your will. And that's true. That's obviously a big piece of what we do, but that's not the only place where you can benefit other people. And it doesn't have to be just after you pass away. So I think we help work with people in those instances too, saying, okay, if you don't have an obvious beneficiary that you're looking to benefit after you pass away, what are you doing during your life day to day? Are there organizations you donate to now? Are there maybe a neighbor that you're really close with that you never thought that you would give them anything?
To be that neighbor, to just get a phone call one day of, oh, your neighbor passed away. Sorry to tell you that.
Yeah,
they left you $5 million, so pay your house off.
Yeah, so I think just helping people know that there's a lot of different options that can help achieve their goals, especially if charitable donations is something that they're looking to do.
Yeah, I think one of the hard things with it is a lot of people, I get the question of like, what's normal, or what do most people do? Even people that have kids. So I get this a lot of times where they have a child or two, whatever. They have a couple adult children and they're their beneficiaries by default, but they also have this other charity or this other interest that they want to support. So maybe they've got $2 million total and they want to give $1 million to their two kids. And then they've got another $1 million they want to support a charity. They're looking at me as the advisor of almost, can I have permission to do that? Can you tell me that's normal so that I feel good about doing it? And the truth is, from my perspective, there really isn't a normal. I don't know if from the attorney world.
Yeah, absolutely. You can never really predict what someone's going to go with, even if it is a same family dynamic that we've seen 100 times before. There's always something different. You just don't know what's important to people and what they're hoping to do with the wealth that they've accumulated over years to come. And I think we do see a lot of that mix of, okay, I want some to go to family or friends or people who I'm close with, and some to go to other charities and stuff like that. I will say in that specific instance, a lot of times we tend to steer people to, if you have retirement accounts or assets that might have income tax consequences to the beneficiary, and you're hoping to benefit both individuals and charities, you might want to think of leaving that asset, like, for example, an IRA, naming a charity's beneficiary on that, and then any other accounts that you have that might not have income tax consequences to the beneficiaries, leaving that towards the individuals.
Yeah, that's an important distinction. So I think let's actually take a step back and go through that again for listeners that are not as well versed in this stuff. So let's say we have really simple $2 million. We'll say $1 million is an IRA or 401k. Another $1 million is in a brokerage non-qualified account. So one's a retirement account. The other one, we have to deal with capital gains, except for when we die, we have a step-up basis. So the idea and what Hannah's saying is we would have the IRA have the beneficiary of a charity on it, so that when they inherit the $1 million, they get the full $1 million, they pay no taxes. The, we'll say, adult child would be the recipient of the non-qualified brokerage account. They would get a step-up basis. They would also pay no taxes. So right off the bat, if you're listening to this, you say some portion of my money is going to go to a charity, some portion is going to go to my adult child. There's ways that we can do it professionally to hopefully pay less taxes, which
Yes.
is always fun.
Always a good thing. That's definitely one of the goals. We work with people
Yes.
to maximize the ability to give to your beneficiaries and people who you want to benefit, not necessarily the government. So,
Yes, it's weird that people don't
Yes.
want to pay more taxes.
Yes.
I think that's a smart way to do it. And I think just recognizing that there is a proper way to set that up if you do the proper planning is important.
Yeah.
A lot of people neglect
Absolutely.
to do that. Okay, so let's say like the way that somebody would actually go about doing this is pretty simple. So if we have an IRA, we know we have to list a beneficiary. So you could choose to list a charity on there. If it's a real legitimate charity, you can do that. What if somebody has a cause that they want to support, but they haven't found the perfect charity that supports that cause? I don't know what a good example is, but sometimes we have clients that ask about doing like a scholarship fund. They want to go back to the high school they graduated from, and they want to give a scholarship after they die to give, I don't know, $1,000 awarded to one student per year for as long as the money lasts, something like that.
Yeah.
How do they actually set that up?
Absolutely. So there's a few different ways to do that. One thing that comes to mind would be donor advised funds. So this is basically a fund that you set up with a company that you contribute your however much you want to benefit a charity to, even if you haven't made up your mind about what exactly you want that scholarship fund to look like, or how much you want it to pay out, or what the stipulations you want it to be. You can make that charitable contribution into this donor advised fund. And then basically that is giving someone the power to direct and advise what happens with those funds after it's there. So it allows you to get the benefit of the making the charitable contribution now, and still gives you time to figure out how to make that happen or what to go through with it.
Okay, so for a donor advised fund, I'm basically appointing somebody who's going to make this decision after I'm dead of where to send or direct money to.
Yes.
Is that probably a less nice way to say it?
Yes,
But
yes.
that's
You can, yep, that works. You can also set them up while you're alive as well. And you just establish them in your name and can name someone to help you work through that. If you don't want to be super involved with figuring out what you need to do, you can. But at that point, it might be easier to just do it directly instead of if you know what you want what to be done with that money or the donation that you make to that.
okay. I think that's something that a lot of people would like to do, and they don't know where to start, which I think is the battle for a lot of this financial stuff or legal stuff. So
Yeah.
in the simplest terms possible, if I want to start a scholarship fund or a donor advised fund, what is step one? Is it just talking to an attorney? Is there like somewhere before that even?
Yeah. So you can just thinking about what it is you want. Talking to an attorney can help lay out some of your different options. We work with financial advisors frequently to figure out, okay, what asset might make sense, like we were talking about before. Some assets might make sense to designate towards charities, others might not. But there's companies that do it as well. So you can reach out. We have contacts for people. I'm sure you guys are also referring to different organizations that can help you manage those donor advised funds. Or if you wanted to set up Rochester Area Community Foundation is a great example as well. That's just an organization that can help walk you through all these different options, and they focus on benefiting the Rochester area community, very aptly named, for donations and charitable things like that as well.
Cool. Good to know. I think that's helpful. What would you say is a big common misconception with this category of giving? What is something that maybe clients come to you and they think it works this way, but it doesn't at all, or there's just, I don't know. You tell me.
Yeah, that's a great question. I would say, honestly, I think the biggest misconception is just thinking that you can only donate to charities if you've reached a certain number of wealth and you've accumulated X amount, and now all of a sudden for tax reasons you need to donate to charities. A lot of times people don't think of that beforehand. So in the situation that we were talking about before, maybe you have an individual who doesn't have any close family members. They might not have thought, okay, what organizations do I want to benefit with this? They might just be focused on individuals, and maybe they don't have a lot of money. Maybe they haven't accumulated a lot of wealth, but they can still leave something to charities if that's what they want. So I think that would be, and even if it's a small portion of your estate plan, incorporating that in some way is always an option available to anyone.
I think the small portion's an interesting twist on it, because a lot of times we have this all or nothing mentality. People think I'm leaving all my money to my kids, or I'm going to cut my kids out and leave it all to charity, or I don't have kids, whatever it is. And I think there's a good opportunity for people that maybe you say 90% of it's going to go to my kids. That's what I want to do. But let's cut out 10% of it and support a charity we care about, or a church, whatever it is. I think a lot of people would be receptive to that if they started to just think about it differently.
Absolutely. Yeah, I think it's great. And it depends too on what people are doing during their lifetime as well. If you have a habit of donating and making charitable contributions, then typically it's more at the forefront of your mind. But if not, that's something that we talk about as well.
Sure. Yeah, that all makes sense. I think some people are just naturally charitably inclined. I can think of a couple clients offhand who they have adult children and like they have that obvious air, but they're always talking about how to support other people and how to do it the right way. And I think for a lot of people that are your typical middle class retiree, if they've been good savers, they've been disciplined, they end up having a lot more money in retirement than they thought they would.
Yeah.
And if you asked them 30 years ago, they would have said, oh, yeah, I'll leave it all to the kids. But now they're sitting here with 10 times the money they thought they would.
Right.
And they don't want to necessarily, not that they don't want to give it to their kids, but they feel that's too much that they're leaving behind to their kids.
Or
They want
their
their kids to
are
earn it.
grown and they now have accumulated their own wealth, and it's less about providing for them. And there's other things you can think about.
Yeah.
It's a good problem to have.
It's a good problem to have. They just, I guess what I'm trying to say is they never thought that they were going to leave behind like millions of dollars to their children. They thought they were going to leave behind like $10,000 to their children.
Yeah.
And now that they're in that position that they have accumulated this wealth and they don't think they're going to spend it in their lifetime, they feel differently about gifting or leaving behind that much money.
Yeah, for
Which is
sure.
interesting. Okay. We'll cover some good stuff. What else do we want to talk about? I'm at a loss.
I think, so for gifting, I think it's always important to think about Medicaid too. We're talking about a lot about charitable contributions and everything while you're alive or after you've passed away. But even just like gifting in general, about gifting to kids, I'm trying to think. Medicaid is always important to think about. Power of attorney talks about gifting. If you're not at the retirement point, now I'm drawing a blank.
Okay.
But
What if we shift a little bit? One thing that we also get is how do you skip a generation? I've got X amount of dollars I've saved. I'm in my 70s now. My adult children are doing fine. They really don't need the inheritance, but I'd like to set up my grandkids some. And a lot of times we're getting the question about how do I help my grandkids with college? If you're, I don't know, not to be morbid, but if you're in your late 70s and you've got a newborn grandbaby, you might not be there when they're in college. So how do you either leave a legacy for that or let's stop focusing on college for a minute and maybe I just want to leave money to my grandkids in general, but I don't want them to get like $1 million when they're 18. So how do I space it out, or what are the trust options with that?
Yeah.
That was a big question. You can pick any one of those points.
That's a great point. Yeah. So I think starting with the education piece. So grandparent wants to benefit grandchild for education. I think one of the best resources available would be a 529 account. So you can fund those grow tax deferred and are able to be withdrawn for education purposes. So that could be, there's up to a certain amount for tuition in high school. Like maybe your grandchild ends up going to private school and they can help with tuition for that, or further down the road for colleges. And it extends beyond just tuition. Like you can use those funds for room, board, books, supplies, stuff like that. So 529 accounts are a great way to do that. I would say if you're thinking about just making annual gifts towards your grandchildren, there's a few different vehicles for that. One thing that depending on the amount of the gift, like maybe you want to do something all at once or you want to space it out, a lot of times we will help people figure out based on the amount what option then makes sense for it. You could set up a trust, but everyone has a different threshold or tolerance level for the administrative hassle that comes with the trust and just tying that money up for however long it might be. So maybe if you're only looking to give $5,000 at one time, or maybe total, the trust might not be the best idea for you. But if you're looking to make $50,000 or $1 million, then maybe we might be thinking, okay, a trust might make sense. Again, there's no like bright line. If you're gifting this much, you should set up this trust, but just something to keep in mind.
Well, that's a good point too. I feel like a lot of times I have these conversations with clients and in their own mind, they've built it up to be way more complicated than it is. Like they're talking about, well, I want to gift this money to my grandchild. And it usually starts in vague terms. They don't come out and say, I want to gift X amount of dollars. It's always, oh, I give money. And me as an advisor have learned to take a pause there and say, okay, how much money are we talking about? Are we talking about, you want to give them $1,000? You want to give them $100,000? Because those are
very different
things. If you want to give them $1,000, I'd say you go to the bank and get some cash and hand it to them. That's fine.
Yeah.
But larger sums require a little more of a high level planning, which is where you come in.
Absolutely. And I think another important thing to think about too would be the gift tax amount on the federal level. So federally, there is a gift tax. You can gift up to the annual exclusion amount, which is about $19,000 per recipient. So me as an individual can gift 5 different people $19,000, or however many people $19,000 each, without ever having to report that amount to the IRS. So sometimes that comes into play as well when people are thinking, I want to benefit my grandchild. I want to give them $50,000. And it's okay. Do you want to give them $50,000 over maybe 5 years? Or do you want to do it all at once? Either way is fine, but just making sure, walking people through what gift tax consequences there might be on the federal level for that as well.
Yeah, and I think that's something that people don't really understand. I don't know if we want to get totally into the gift tax thing right now, but gifting over that limit isn't necessarily a bad thing either, depending on what your goals are.
Yes, it's definitely not, because you do have a certain amount, which is very high. The federal exemption is 13.9 million. So you can
So
get,
most of the retirees I'm talking to, they're making gift to their grandkids. They're not talking about exceeding 13 million. So
it's usually fine. You might have to file a gift tax return, but no gift tax will actually be owed
and I
because you
think
can use that exemption.
that's a
amount.
confusion. People are like, oh, I'm going over $19,000. I'm going to have to pay tax on this money.
Right.
It's, no, not really. You just have to fill out this form, or you have to pay your CPA to fill out this form. But you're still
Likes
okay.
the record, but you don't have to pay anything.
So I think that confuses people and it scares them away from doing the larger gift.
Yeah. And I think too, from the Medicaid perspective as well, it's also important to think about the amount of gift, just to see. I'm sure Dave touched on this in your podcast episode as well, but just the 5-year look back period is a huge thing for Medicaid. So if you are at the age where you're retiring, maybe you're perfectly healthy now, but you're getting older, you can never predict with certainty what's going to happen. If you think you might be in a situation where you might need Medicaid or long-term care down the road, it's always important to keep in mind that when you go to apply for Medicaid, they'll ask for 5 years of bank statements and records, just to make sure that you haven't gifted away your money to qualify for Medicaid. Just because to qualify for Medicaid, you have to be under a certain resource limit. Balancing I want to gift my grandchildren money with, okay, we might be like, we are doing some type of Medicaid planning, or we might be in this 5-year look back period. What's the best way to do that?
Yeah, Medicaid is an interesting part of it. And I don't know if we got into this on the podcast today with Dave, but we talked about, you mentioned long-term care there briefly. So this is totally off topic, but we'll go there anyway. Do you have a principal thought on long-term care insurance? Because it's become such a strange and evolving field throughout even my career that I've been doing this, where it used to be you had these standalone long-term care policies, which were at one point fairly reasonably priced. And then we saw the prices go up over about a decade. And then eventually, I think we're at the point now in New York State, there's only one carrier left that offers a long-term care policy, a traditional standalone one, I should say.
Yep.
You must run into this all the time, but what is your baseline recommendation to the general audience?
Yeah, so I think it really depends, obviously, case by case. But the most typical person that we see does not typically have long-term care insurance, just for that reason. Maybe they had it years ago, but the cost of maintaining the policy has just gone astronomically high. Hard to do that year after year. So a lot of people don't have long-term care insurance. If they're at the point where they're coming to a decision, okay, should I purchase long-term care insurance, or should I engage in some type of other planning? So we obviously are not insurance agents, so we don't really walk through the details on that. We just try to make sure people know that there are options available beyond just trying to find those long-term care policies. And they're getting fewer and far between. Very similar experience to what you're describing. We don't see a lot of people that have them now. And we do help people with other options and things that are available to them beyond just having to be covered. If you don't have long-term care insurance, it's really not the end of the world. Most people are in that boat.
Yeah, I think it's interesting. You and I are both on the outside looking in on this. I don't do insurance. I don't do insurance anymore. So I refer out that business. I'm sure you do too, but I get so many questions on long-term care insurance. You must also. And my answer has become that you do not need to have long-term insurance, but we do need to have a long-term care plan. So let's address it. It doesn't help to not talk about the issue. You definitely need to address it. It's a very real situation that you're probably going to be in at some point.
Yeah.
But I don't know that buying an insurance policy is the right answer for most people at this point for the cost of it has.
Yes, I think we pretty much agree with that statement. And depending on what stage people are in, like if you're in good health, you're just getting older, then yeah, you might think long-term care insurance might be on your mind, but there are other things you can do, like other plans you can engage in to protect your assets that will allow you to qualify for Medicaid and the benefits that are available for you there without needing to pay these crazy amounts for long-term care policies.
It seems like the people that can afford the premium, because it is so high, if you can afford the premium, you probably have enough wealth to look at other options. And the people that really probably need the insurance can't afford the premium, which is unfair, but that's the reality of financial planning. It's better to have money than not have money, weirdly enough.
Crazy.
All right.
Yeah.
So that was a weird segue. So that we got away from our original topic, which is
Yeah.
talking about how to leave a legacy. We talked about long-term care a little bit, which I guess it ties in. Anything else you wanted to mention on either the donor advised funds or estate planning in general?
Yeah, I just think estate planning in general covers a lot of ground. There's a lot of different documents and things to think about when you're updating your estate plan or creating it for the first time. So obviously we talked about the will, touched on other gifting options you could have during life, long-term care plan, all important things to keep in mind. The two other documents that I think are equally as important are the power of attorney and healthcare proxy. And particularly in the context of gifting and giving, power of attorney is also important just because that document is a document that operates while you're alive. You name an agent to handle financial transactions on your behalf. So you're talking about making these gifts. Maybe you do give money to your grandkids every year, or you do donate to a charity, but then all of a sudden something happens. You're not able to write checks anymore. Or maybe you're incapacitated, diagnosed with dementia, or something else is going on that you're not able to carry out those lifetime gifts that you're used to doing. And that power of attorney is a huge piece because you have named someone who you trust to be able to do that for you. And there's a whole section in the power of attorney that talks about gifting. So what specifically you want to give your agent the authority to do on your behalf. If you just want annual exclusion gifts, if you want them to be able to donate to charities, or just, it really spells that out. So going through that while you are able to, and while you can name people that you trust to be able to do that is really important as well.
It all comes out, do it while you can.
Do it while you can. Yes.
I don't have to tell you this, but with estate planning particularly, people always think they have like another 10 years to figure this out. And of course, it's not always the case.
Yes.
So if you're listening to this and you haven't done any of this, get it done.
Yeah. Not fun to think about. So it's easy to push off. So it makes sense.
Yes. It's easy to procrastinate, but it's important. Cool. We got to wrap up here. How do people find you?
People can find me. I'm on the Woods Oviatt Gilman website.
Okay.
Yeah.
Are you on LinkedIn?
I am on LinkedIn.
Okay.
Yep. Hannah Cannon.
All right. Yeah. And you also have a podcast at your firm that I think you make some appearances on. What's that? That's Into the Woods?
Into the Woods, not to be confused with musical.
Okay.
But yep, we have a few podcast episodes out. I think there's two really good ones on the long-term care piece that we talked about. I'm on an episode that will be airing shortly that's on just if you're a snowbird. You've got property in Florida, you've got property in New York, just some considerations to talk about for that as well. Yeah, good stuff.
Great stuff. All right. Thank you for being here, and thanks for listening.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.